managing your business and provide information on how to grow your business. The basic formula for a P&L statement is this: sales minus cost of goods sold equals gross profit. Gross profit minus operating expenses equals net profit. Let's define those 5 terms. Sales, also called income or revenue, is the total amount from selling your product or service during a certain time period. Cost of goods sold, also called variable costs, are those costs incurred as a direct result of producing or selling the product or service. Cost of goods sold may include cost for materials used, direct labor, manufacturing costs, packaging, and freight. Also included are fees from merchant services when your product or service is purchased with your customer's credit card. There are some types of service industry businesses that will not have cost of goods sold. Gross profit is what is left over after deducting cost of goods sold from sales. It is the money available to pay the operating expenses. Operating expenses are expenses associated with your ongoing business operations such as rent, salaries, insurance, utilities, and advertising. Net profit is what remains after paying the operating expenses. Net profit is the source to pay for loan repayment, owner's draw, income taxes, and reinvestment into the business for expansion or equipment.
For the balance sheet, we look for once a month. And then we have meetings every 3 months as well, and also the yearly balance sheet. That's what we do. As far as sales, we look more daily, but we have meetings weekly so that we know where we are. How are we with our goals that we set for that week?
Balance sheet. Now, the balance sheet shows what you own, called assets, what you owe, called liabilities, and what's left over, the net value or equity in the business. When a business buys assets, it pays for them with either borrowed money, liabilities, or equity, money kept in the business. The balance sheet numbers change each time you have a business transaction. Think of the balance sheet like a scale. Assets and liabilities alone are out of balance until you add equity. The last weight put on the scale makes it balance. A business that manages its liabilities and builds equity over time is considered less risky by lenders and better able to weather economic downturns. Assets are divided into 2 categories: current and non-current. They are listed according to how liquid they are or how quickly they can be turned into cash. Current asset examples include cash, accounts receivable, and inventory. Cash is the money you have in the bank. Accounts receivable is cash owed to you. Inventory is product you own that will be turned into cash, and non-current assets are furniture, fixtures, property, and equipment. Liabilities are what you owe and are also divided between current and non-current. Current liabilities are bills that are due in the short term, generally within 12 months, such as what you owe your suppliers and vendors for your purchases. Long-term liabilities are mortgages and loans payable over a period exceeding 1 year. Equity, known as net worth, is what the shareholders own as a bottom line. This can be profit that remains in the business and also money owners have invested in the company. It's simply figured as total assets minus total liabilities.
The cash flow statement has to be something weekly because your money is coming in and your money is going out of the bank account, so you need to make sure, okay, how much is available and forecast those expenses that you have for the month and for the week and pay attention to the activity on the bank account. And so we truly make the effort to make weekly reviews of that.
Cash flow projections. A cash flow projection is a financial statement that tries to show how cash is expected to flow in and out of a business over a future period of time. A cash flow projection is used to see if projected cash receipts, inflows, will be sufficient to cover projected cash disbursements, outflows. In other words, a cash flow projection is a tool to help you manage your cash so you can pay your bills on a timely basis and keep the doors of your business open. A cash flow projection is a great tool for setting sales goals and for planning for expenses to support those sales. It allows you to see an upcoming cash shortage and proactively plan to solve it. If you need to plan for a large expenditure, such as an equipment purchase or move to a new location, a cash flow projection is the perfect tool. If you have a seasonal business with large inventory purchases, a projection can help you have the cash on hand to make a large inventory investment when you need it. A P&L statement can mask cash shortages. A cash flow projection helps you see the cash status of your business now and plan into the future. A cash flow projection is a good way to prepare and plan for your financing needs and is often a required part of a business loan application. There are a number of decisions a business owner can make that can impact cash flow positively. Each of these decisions should be informed decisions based upon your market, customer base, and vendor relationships. Some examples are: increase the number of items you sell, increase the price, reduce your expenses, change the timing of expenses, obtain sources of cash other than sales, such as line of credit to use during seasonal dips in sales, reduce or change the timing of your owner's draw, research vendor options for buying inventory at lower price or obtaining credit from vendors, establish policies to get paid sooner from customers. It's common for businesses that struggle with cash flow to turn to sources of quick cash, such as credit cards or online loans, which often come with high interest rates, to get through slow periods. This is a slippery slope, and we do not recommend this practice. Rather, understanding all of your financial reports, developing discipline in reviewing them, and working with your CPA or financial advisor will help you manage cash flow long term.
Just to quickly recap on the three financial statements that we regularly monitor, our cash flow, and for a new business, that's actually probably the most important financial document that you're going to look at, or financial statement that you're going to look at. We do that on a daily basis because we've got to stay on top of our cash flow and make sure we don't get into a situation where we're bouncing checks and so on. Our income.
All right, so. Can everybody hear me and can everyone see my screen? I just want to make sure that everyone can see my screen. Is that a yes? No? Everyone can see my screen?
Yes.
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 Okay, all right, appreciate you. Okay, so what you just watched are the three pillars of just financial management: cash flow projections, income statements, and balance sheets. And you can always go back on Initiate Prosperity or rewatch that video. So let's go back into the scenario, understand why starting with understanding those three things is important. So once Damien has an understanding of his income statement, his balance sheet, and his cash flow projections, what he can kind of do now, because he understands what his fixed rates are, right? Being what is his cost of goods. So if he has a vending machine business, he's going to need vending machines, going to be inventory, purchase cookies, sodas, all that good stuff, right? What is going to need to do is utilize a break-even sales calculator. So let's say these are the numbers for Damien's first year of business, right? If he's like, okay, I want to make $40,000 my first year, that is my goal for this business. And he put together his income statement, his balance sheet, his cash flow projections, and he's kind of understood that the cost to make that is probably going to be $12,800, which means that he can estimate he can project a gross profit of $27,200. And his operating expenses are probably at $12,000. Operating expenses can range from an array of things, such as, let's say he paid somebody, or is currently paying like a monthly subscription to have his website on, or his credit card processes, things of that nature. So he can say that, okay, $15,200 is what my net profit is going to be. Now, why the calculator is really important is he may want to make a little bit more than that. He may say, hey, these cookies, I can probably charge people extra 15 cents, or this subscription that I'm paying, I don't really need it for my business. But what he really wants to make sure is that the first year he makes break even. And break even, which is right here, the $17,647, what that essentially tells Damien is, hey, you need to at least make $17,647 to not lose money, right? Just to be able to pay the cost of goods just to be able to pay your operating expenses, and then you can grow from there. And what's actually more important is how Damien is allowed to plan ahead utilizing his calculator. So let's say Damien is like, okay, first year I made 40,000. Next year I want to buy a new vending machine. I want to now hire somebody to do some marketing for me, right? Let's say he finds a social media guru and he's doing Google ads and all of those things, right? So the vending machine is probably $6,000, $200 for marketing, right? That's an extra $8,000 in expense. And now what he can say to himself is, now this business has to generate $29,412. And what that looks like in this scenario is when Damien is selecting a location, he needs to make sure that his numbers make the $29,412. Because if you're not making money, or at least break even, you're not doing well at all. So that's one of the calculators that you can access on Initiate Prosperity. I now kind of want to go into the scorecard. Right. So this is a lot of information, but I just want us to focus on a few important parts of this Excel worksheet, right? And as I mentioned before, the reason why we want to look at this is to understand our financial ratios, right? So before I even go into this Excel sheet, let's understand or kind of do an overview or a little reminder of what some of these ratios mean. Okay, so first and foremost, financial ratios are not all equal, right? Depending on your business model, a lot of these may not apply to you, but for the purpose of this conversation that we're having, if Damien is trying to understand if now is the right time to expand, he needs to understand, hey, what is my net margin, right? So number 3 here, his net margin is going to show him how much profit his business is making from each dollar of sales, right? That just reflects his overall profitability. He's also going to want to understand things like accounts receivable, right? So accounts receivable turnover is going to show how quickly his business collects payments from customers, indicating his cash flow efficiency. So are his credit card processors working in time? If he's wholesaling, if somebody purchased online, like how quick is he to turn that into actual income? Return on assets is also going to be a key indicator for Damien. So ROA is going to measure how efficiently his business is actually utilizing his assets, which in this case are the vending machines and all the inventory that he has to generate profit. And I will, at the end of this webinar, I'll send you this this presentation so you can have all of these. And Initiate Prosperity does a nice job of actually explaining these ratios. But let's put that all into this Excel sheet now, right? So one of the first things that we want to look at or pay attention to is the income statement and the balance sheet. And we also want to realize that this chart is going from the right side to the left side. So his revenue for year 1 is here, year 2, and year 3. So first year of sales, 40,000 to 50,000 to 100,000. So everything is increasing. Cost of goods sold is also increasing because the business is needing more. His gross profit is increasing as well as his net profit. As far as his balance sheet, as we learned in the previous video that we watched, is basically what he owns and what he owes. So cash as an asset, accounts receivable would be an asset, average inventory, and then we get into the liabilities. So I want to give you guys a few seconds to look at these numbers. If I can get anyone in the audience to tell me from the numbers that you guys are seeing right now, does this seem like a business that's growing, a business that's stagnant, or a business that's losing money looking at his income statement and his balance sheet?
appears somewhat stagnant to me.
Stagnant. Okay, why would you say he's stagnant? What numbers are you seeing that's like you're not really doing well, but you're also not doing bad? What numbers, what line item are you looking at?
I'm looking at the accounts receivable.
Okay. Okay, yes. So the accounts receivable is really from Damien's business, right? Remember, he does vending machines. So this is all the money that he's probably making from his the credit processes or people that's purchasing machines, right? So it's increasing, but it's nothing too crazy. But what I would also like to point out is, and this is the reason why the ratios are important, is what are these numbers relative to, right? So if your business, let's say you sell clothes, right? Your numbers compared to somebody else's numbers are going to mean two different things. So it's very important that you do your research and understand what are your numbers supposed to look like according to your industry. So let's move on to the scorecard a little bit. And again, I know it's a lot of information right now and a lot of things that we don't necessarily understand or know, but what I want you to pay attention to are the years. Pay attention to the balance sheet ratios, the income statement ratios, the asset management ratios, and I am not going to go through all of these ratios for a couple of reasons. One, a lot of these ratios has nothing to do with the business that you probably run, right? Like I said, all of them are not equal. Every business doesn't have the same things to look at. That's one. And then two, a lot of them, although it matters, your business is probably not at that stage where you can start looking at it. So the ones that I will focus on are the ones that have the benchmarks for Damien's business, right? So first and foremost, we'll take a look at the current ratio. So the current ratio, I'm not sure if you guys remember from the example that I gave, but it's basically looking at the company's ability to cover its short-term liabilities, right? So every vending machine that Damien has, in the event, like let's say his business took a turn for the worse and he needed to sell the vending machine just to pay the debt that he has or maybe he owes the people that he's getting his inventory from, to every dollar, right? So every dollar of debt that he has, how much money does he has to pay that? So the 3.0 that you're seeing here is basically saying $3 to in cash, I should say, or in assets, $3 in assets can actually pay his liabilities. Same thing for his debt to worth, right? So that's looking at just the overall worth of the business. That's gonna give Damien an understanding, is he over leveraging here? Is he financing too much or is he just where he's supposed to be? So if you look at the benchmarks, 2.3 is actually stayed pretty stagnant. And then we want to look at the net margins, right? So the net margin, as some of you may remember, really tells you the profitability of the business. How much revenue, for every dollar of revenue that the business generates, how much of that is actually being turned into a profit? So for Damien's industry, 20% is where he wants to be at, right? So you can kind of see he's actually not doing too well in that department, right? He's went from pretty stagnant at 16% to diving down all the way to 10% the last year, right? And then the last thing that I want to look at is the return on assets, right? So if he were to look at every vending machine that he's purchasing or of the inventory that he's purchasing, how much of that is he actually turning into a profit? His benchmark, right, his industry is saying that the vending machines and the assets that he had, pardon, it should be returning about 11% of that into profit. So year one, 14.3. So he's kind of like stayed pretty stagnant over time. And like I said, I'm not gonna go through all these, but you guys are more than welcome to take a look and see if any of these apply to you. But I do want to ask a question based on these numbers that I just gave. The same thing. Is the business doing really well as far as, this is giving signs that it's time to expand? Is it stagnant? Or does Damien have a whole lot more work to do? And the business is actually not performing well? Like, what do we think just looking at these numbers?
I think he needs a lot more work to do. And his pricing may be the issue.
Okay, that's definitely that would make sense. If you look at the net margin, right? He took a big, even though the business is expanding, he's been able to get more vending machines, but he's actually not turning everything into a profit. So that may be the case. And these numbers, right, is just for you as the entrepreneur to really sit down and look at things from a factual standpoint. It's not like, oh, I want to make more money, or people are telling you need to grow fast. It's actually like, okay, how's my business performing? And is it time to come to someone like us, come to a CDFI and say, hey, I'd like X amount of money to grow my business, or I want to go here. You can actually come with these numbers and actually articulate the reason why you feel like now is the time to expand. So I'll go ahead and stop sharing my screen. Just want to allow the next 15 minutes to let the audience ask any questions that they may have. It doesn't really have to relate to the presentation. It may be information about financing or our process, anything that you guys want to go over. More than happy to answer any questions.
I have a question.
Mm-hmm.
Can you hear me
How
okay?
you doing, Dee?
I'm
Yes.
good. It's nice to meet you, Suko.
Mm-hmm.
So my question is, as we're looking, right, this example, Damien's been in business for 3 years, and so we have a lot of accurate current data to look at and reference. But when it comes to a new business, is a new business able to, if with proper research and things like that, able to present projected data, to you're in this organization, and be given an opportunity, to kind of get that. Yeah.
That is a great question. It's a question that I hear a lot based on the role that I play, and being that I'm really the first person that analyzes your business as you come to us into our organization. And the best way that I can explain that, and maybe Sean and David could chime in as well, is as a startup, I think the number one thing that you want to be able to articulate is what's your operating expenses, one, and what are your costs of goods, right? So you want to understand, to operate this business and to be successful with it, what are the fixed costs? If you can show that, right, maybe from the research that you've done, that allows us to say, okay, like, this is what it's going to take. So those are the numbers that we can draw on. As far as your projections, we really focus on your capacity. So as a business owner, you're building a system, right? So if you say, hey, Suko, first year, I want to get 100 clients, right? One of the things that I'm probably going to look at is, well, what's your marketing like? How are you doing your marketing? How do you even get one client, right? And if you say to me, hey, I pay Google ads, right? There should be some type of numbers that we can base that $100 customer off, right? So if you say I spend $50 to get 2 clients, right? We could kind of guesstimate and say, hey, if we give you X amount of money to go towards marketing based on your business plan and how you do your marketing, we can help you articulate those numbers once it comes to your projections. So that's the best way that I would describe it, but I don't know if Sean or David kind of wants to answer that question.
Yeah, the way I'd answer it, I guess the first question to answer your question, D, is yes. We for a startup, we work with you on projections. In fact, most clients do not have projections when they come to us. That's an area that they're not comfortable with. So we sit down and we work on projections. as Suko said, you know, your projections as a startup have to be based on something. So that's where we want to deal with what your assumptions are. What are your assumptions and where are you getting them from? So if you've never done this business before, but right off the bat, you say, I think I can sell $100,000 in my first year. We're going to ask, well, what's that assumption based on? What experience do you have? Ideally, maybe you started it on a small scale. Maybe you're doing it at home first, and you're just doing it on a small scale with friends and family. And based on that, you're going to extrapolate and take that out. You say, well, I'm able to sell to my friends and my family, and I've been doing a little bit of catering on the side, and I'm doing about $800 a month. Okay. But you believe that with a $10,000 loan, you could double that because now you could advertise and so forth. That's all we're asking is, do we do it? Yes. The second question is, where are we going to get the numbers from? What is it based on? And so that's generally the thing. But yeah, we absolutely, for startups, do projections because as a startup, you have no historical data. And we do projections for established businesses as well. But for a startup, absolutely, the projections are critical. But the question is, what are your assumptions? Are they realistic? Are they things that we believe can happen? Because unfortunately, too often, entrepreneurs tend to be very ambitious in their projection.
Yeah. Thank you, Sean. I appreciate it.
Great question.
I have a question. This is Maurice. How do you go about setting your profit margins for business? Is it what the market can bear, or is it where you set your projections at 50% above the cost of doing business or cost of goods sold?
Okay, so if I understand your question correctly, you're asking how do you go about estimating your profit margins as a business owner?
That's correct. You know, is there a formula or a percentage that you use or look?
Yeah. So what I would say is from the presentation, right? Utilizing the break-even sales calculator, I think will be a good start. Because you get to understand your fixed costs, right? Fixed costs as in I need to spend this in order to even have this business, right? For a Damien, he needs the actual vending machines to start selling. And then your variable costs, your operating expenses, right? Understanding what those numbers are. And then using the calculator, you'll see like, okay, this is my net profit. If I do these numbers as far as sales is concerned, this is what I can kind of expect. Now, what does that look like as far as your industry? As I mentioned, you have to do the research, not just look on Google and be like, what's the net profit margins for a vending machine business, right? But doing the research as far as reaching out to someone that actually owns something, maybe coming to a CDFI like us and saying, hey, the people that you work for or work with, these type of businesses, what are their typical net profit margins? I know that we have a platform called Ibis World that we utilize, and we get a lot of our data from, and we pay a whole lot of money for that. But we're more than willing to help you find those numbers, if that answers your question.
It does.
Okay. So I've seen a lot of people came in as the presentation was going. So I will definitely be sending the recorded version. And actually a lot of people are still joining now. But any other questions, anything else that we can answer for you guys?
What was the template you said you use? What was that? The template that you use to estimate your cost?
The break-even sales calculator.
Or break-even sales calculator.
Yes, and if you registered for this event, you should have gotten an invitation to initiate prosperity, so you can go ahead and search that, and you'll find that calculator. If you didn't, let me put my email address on here in the chat, and you can send me an email, and I'll be sure to send you that as well.
Suko, Bonnie put in the chat to remember that we also have the size up through SourceLink as another way as well.
Okay. Yes. Let me see if I could put that in the chat so you guys can see what we mean. And Size Up, to give some background information, Size Up it's a great platform actually. It really helps you do some market research. And the reason why I like it, and I think the reason why our team utilizes it, is it gives data based on like local businesses, right? Baltimore City and Baltimore County. As some of you may know, if you type up, I don't know, like what's the net profit for a clothing brand, you're gonna get nationwide data, right? But you really want to understand if you're a startup, this is what my area and what the business in my area are able to achieve. So let me go ahead and put that in the chat as well.
While Suko is doing that, how many, I just kind of curious, how many people on here are already, you can put, put a reaction or a thumbs up. How many are existing business owners do we have? How many are existing business people already in business, have a business that you're currently operating? All right, I see one hand up with Jimmy. All right, so I assume most of the other people, okay, Dan has his up as well. Sharina, do you guys mind sharing? It's up to you, you don't have to. What type of business do you have? Because one thing Suko mentioned, each business is different. If you're a manufacturer versus a service-based business versus a wholesaler. So part of what we do is we work with a diverse number of businesses, but each business is different and unique. So we definitely would want to tailor our answers based on your type of business or what it is that you do. And if we can be of help, in terms of helping you understand how to access information that helps you run your business better.
Someone said it's complicated.
It's complicated. All right. Wait. I saw somebody send something in here. Residential care. Okay, we've had a number of clients with residential care businesses. Okay. And those of you who are startups, what types of businesses are you looking to start up? Remember, this is your opportunity to ask questions. I always tell business owners, you can't be shy as a business owner. If you're not comfortable talking and sharing your business, this is your opportunity to get answers to the questions that you have.
Yes, good afternoon, Sean. Just a little bit about myself. My name is Jimmy Robinson. I am in community development and affordable housing development. So I do mainly, right now I currently do grant and community development consulting, but I also do affordable housing development as well. So I'm currently right now pending a few developments in West Baltimore as well as East Baltimore. So
okay,
yep.
So you're a developer. You actually buy and develop properties.
Yes.
Okay.
Yes.
All right, that would be on our real estate side. We have a real estate department that does that side of developing and so forth. So definitely, if you want to reach out to us, or we can put you in contact with our real estate development side.
Okay, my question: do you all have also work with not just rental, but also affordable single family development as well?
You mean developing single family homes and selling single family homes?
Yes, sir.
Yeah.
Okay. Awesome.
Definitely reach out to our real estate side. Absolutely.
Will do. Thank you. Thanks, Sean. Appreciate it.
Before we get the next question, I'm putting Jacqueline Whitley's email on there. Hopefully you guys don't bombard her with too much. But Jacqueline is our administrative personnel here. So as far as our process and how things work, if you're interested in financing or any of the resources as far as technical assistance that we provide, you would reach out to Jacqueline. She'll kind of make sure that, we're able to service in your part within the area that we service. And then you'll speak with me and we'll get the process going. So if anyone is wondering how they could start the process of dealing with BCL, I'm putting her email on in the chat as well. Any other questions? Anything else I can answer for you guys?
Okay, I'm Maurice. I'm initiating the startup of a fractional ownership company where individuals can buy a share in an aircraft and pay the hourly cost to operate the aircraft, and primarily along the East Coast. I'm looking at the small and medium-sized companies, and I'm interested in developing that operation. I have some sense of who my competitors are, and structuring this business plan is a little bit more involved. And I know the accounting is going to be a little bit different. So I just want to introduce myself and let you know where I am.
Okay. Nice to meet you, Maurice. And another thing that I want to say is BCL, like we're really connected within just the ecosystem. Another thing that we provide is just connections to people, right? So more than happy to, I'll put my email on here as well. If there's anyone that you are looking to get in contact with, to continue your business, just let us know. We'll do our best to get you in contact.
Yeah, Alexis, could you explain your question? I see your question. When you say the market fit, can you give a little bit more detail on that as far as when you say market fit? He's still on mute. Yeah, I'm not sure when you say the market fit for a business. She's still on mute. Yeah, I don't know if she can't come off mute. I'm not exactly sure when you say market fit. Okay, to be sure the solution is the need. Well, there are a couple ways, and that's what I was thinking you were asking. A couple ways you can do that. You know, there's both what we call primary research and secondary research. Primary research is asking questions, going around to who you think your prospective clients would be and asking questions, say, hey, can I, ask you a couple questions about, so for example, let's say you want to start a dry cleaning business where you pick up people's or wash and fold, say, and you want to pick it up. You might go around to the neighborhood that you want to do it and talk with a handful of people or send out a survey and ask them. That's primary research. Secondary research is where you go on the internet, you go to the library. Speaking of which, Baltimore County Library has a really good set of resources for small business, and start doing the research that way. But the best way to get market fit is really to do primary research where you ask the people in your target market, your targeted market area and targeted client, would they, what is their need? Do they see a need for it? Ask them what price they'd be willing to pay, all of that information. That's generally the way you can identify whether or not there's a need. And that's a very good question, because sometimes people start a business without doing any primary research, only to find out there's either no need, or if there is a need, they're not willing to pay the price that's going to be necessary for you to be successful. And that's a tough thing to find out after you've invested time and money, that the idea just is not really something that can be successful. So I'd say primary research is the main way, followed by secondary research, as well as maybe using some resources out there, whether it's SCORE, through the SBA and others, to sort of bounce those questions off of, and asking and doing that. But primary research, I would say, would be your main way of figuring out market fit.
I just want to elaborate on one thing as well. So proof of concept is something that's always on my mind. So I think it's very important if you are a startup or just recently started your business, as far as finance is concerned, right? You want to be able to document everything that you're doing. And the reason why I'm emphasizing is I speak to a lot of people, they start off with, it's just a side hustle, right? It's just something that you're good at, something that people, whether it's you're braiding hair or, I don't know, you're selling drinks, right? But documenting that, putting things into a profit and loss statement, not commingling funds, establishing a business bank account right? Handling all your expenses on there. What else can I say? If you did run a business for like a year, when you speak to your accountant and they're like, oh, you didn't really make that much money, you don't need to file it. Don't do that. Because my thing is, if you made $50, it's not like the IRS is coming after your $50. But you not documenting it and then you later going to someone and saying, hey, give me X amount of money, although you may have done what you said you done, but there's no documentation of it, that would really hurt you. So that would really be my advice as far as building your proof of concept and gearing yourself to one day go fundraise. So that's something that I would definitely emphasize. Okay. Is there any other questions? If not, we can go ahead and end this call. Any other questions? Anything that I can answer for anyone?
Yes, I have a question. Is there a particular credit score that you may be looking at when you're looking to do these loans?
Great question. So as a CDFI, and one of the things that make us different as far as how we operate is no, you don't need a specific credit score. Now, I do want to emphasize that we're still a lender, so we still follow basic lending guidelines. And what that means is you can have a credit score of like a 630, right? We'll work with you, but if we do pull your credit and you have late payments, delinquencies, bankruptcies, those things will definitely delay or hurt your chances of actually receiving financing with us. Now, the resources that we use to combat that, because a lot of our clients have credit challenges, is our third party partner called Initiate Prosperity. They are a credit coaching program, and it's something that we pay for out of pocket. So they'll be able to help you come up with a comprehensive plan. Like I said, it's free of charge. So if you are interested in that, you can go ahead and email me, and I'll get you in contact with Trust Plus, and you can go ahead and start working on your credit. Hopefully that answers your question, Maurice. Oh, also, I should ask collateral as well. So our banking experience is completely different if you would walk into Chase or MT Bank. If you walk into Chase or any of these other financial institutions and you don't have the right credit score, or you don't have no asset to really put up as a as collateral, that's really the end of the conversation. So here at BCL, we don't require collateral, and it's not even something that we aim to receive. So should note that as well.
Thank you. That answered part of my question.
Okay, so all right, there comes the questions. All right, so eligibility, Jacqueline, do you want to kind of talk about things that would, I don't want to say disqualify you, but would make us not be able to help you? Maybe you could answer that.
Sure. Good afternoon, everyone. So mainly, your area is going to be number one. We want to make sure you're in the correct area so that we're able to service you. In those areas right now are Baltimore City, Baltimore County, Anne Arundel County, Harford County, Howard County, Carroll County. So I get a lot of questions about that, and then I can go into detail about that if you reach out to me via email. But that's a main thing that would make you ineligible for us to be able to even work with you. Another thing that we're looking for, I know we went over the taxes and we went over, all of the different financials, but we really, really need 2 years of taxes from you. As a startup business, we would accept personal taxes. Businesses that are 2 years and over or already operating and have filed taxes, we would need to see your business taxes. And that would definitely make you ineligible if you do not have your taxes. And so that's two of the main things that comes up a lot. Folks are in a wrong area, or they haven't filed taxes, or if they have filed taxes, if they have not filed them, they haven't worked with the IRS to get an extension letter. And that's something we do accept as well, as long as we're understanding that you're going to file, that you have made recommendations, regarding your taxes, you just haven't done them. But you have okay from the IRS. Another question that comes up, if I owe money to the IRS, am I still able to work with you? The question is, if you're in an active payment plan with the IRS to pay your taxes off, then we can talk to you about potential funding and moving forward. If that is not in place, then we would need you to take care of all those things. Another thing that's a big thing is bankruptcy. And I get that question a lot. We are able to work with you if you have filed bankruptcy, but if you have not had that charged off of your account for the, within 2 years of you coming to us, then we would not be able to move forward. And so that comes up a lot. And I just those are the main things to me: the taxes, bankruptcy, and location. Those are the things that make folks ineligible when I speak to them. A lot of times I just see someone in the chat. You're saying, Sandra, what if you're just starting your business? We would definitely take your personal taxes. I would need 2 years of personal taxes if you don't have the business ones, and that's completely fine and acceptable. But those are the main things that I think about when I think about someone not being eligible for our program. I can't think of anything else off the top of my head that would stick out. But again, my email address is here. Anyone is able to, reach out to me. I can give you a list of the documents that we're looking for, and also just give you a bit of background regarding the process. There is a fee, Alexis. Thank you. Great question. There's a $100 application fee that's due, and there's a $40 credit check fee. The thing about that is, though, we're not looking for that as soon as you email me and we're scheduled. We want to actually work with you, figure out what your needs are, how we can best assist you, and get your, business plan looked at, get your finances and your, financials in order, profit and loss statements kind of reviewed, so we can just kind of see what type of deal we're working with. And then when we move you over to actually working with a loan officer, it's at that time they're going to pull your credit, as Suko mentioned. Even though we don't have a score, that will happen because we are a traditional lender. And it's at that time we will request that application and credit check fee. So the entire process would be $140 after you have completed the TA program. And we feel that you're eligible to move on to the step, which includes the application. I hope that helps. If anyone has any questions, please feel free to speak up or write in the chat.
Okay.
I just had one more question, if that's okay.
No, go ahead, brother.
Yeah, so I was just wondering, does the BCL also include like opportunities to maybe say purchase businesses like on a joint venture, like collaboration also, where like you guys may be able to help partner with the debt and then we bring in equity, or how does that, could you all work with certain deals like that as well?
Did you want to take that, Suko, or?
I do, but yeah, so we, as far as purchases is concerned, we do review deals like that. But those are to answer your question, yes, but most of the things that we do and most of the deals that we do is on a case-by-case basis, right? So it's gonna have this certain requirements, and I could probably spend all day kind of going over that. But I would probably say you can email me. Me and you and the loan officer could have a conversation about what we accept and what we don't accept. Because that's a very thin line. Those are the type of deals that's in a thin line. So that's how I would answer that.
Okay, now I appreciate it. Your email's in the chat, right?
Yeah, I'll put that in there one more time.
Okay, appreciate it.
Alexis, I'm sorry, I didn't mean to interrupt you, Jimmy. I hope you were done.
Yeah, I'm good.
Okay. Alexis, you mentioned what is the review? Can you let us know what review you're speaking about? Or get us some more clarification so we can answer? Okay. You can also email me, Alexis. I'm happy to talk to you about anything. I just wanted to have clarification on exactly what review you were speaking about. But we can move on if you want to.
Review of the business. So review of the business happens depending on what stage you're in. So the technical assistance program is really focused on your infrastructure. Our goal is to really have all of our clients become lendable, right? So if you do receive financing from us, or if you want to look for financing elsewhere, or if there's another time that you want to go fundraise, your business has to look a certain way as far as paperwork wise to be eligible for financing, right? So what does that mean is making sure that you're doing profit and losses on a quarterly basis, making sure that you're not commingling funds business account wise. Your taxes are in order, a thorough business plan, financial projections. That is just the basics, but like I said, every business and every deal is kind of different. So for businesses that do government contracting, we'll definitely be reviewing the contracts that you currently have in your pipeline. If you are doing a build out, right, we get a whole bunch of clients that, let's say you want to open up a salon and you have a build out plan. So assessing who your contractor is, assessing just the overall build out plan, right? So it ranges, but what I said before would probably be like the basics of the review. And then when you get to underwriting, I wish we had one of our loan officers here, which I don't think we do. That's like a separate review that just focuses on more so on the structure of the deals. And I think I should mention what our rates are. So both of our products are 9.25% as far as interest rates currently right now. And we can amortize it or stretch it out to a maximum of 6 years, I believe. So those are the two things as far as review is concerned. Okay. All right. So you guys all have our email addresses. I'll be sending $140 is the cost, Alexis, as far as the total. But it's not, that 140 is not due once you start speaking to us. So yes, I will definitely get you guys the recorded version of this call. You can email me if you didn't receive access to Initiate Prosperity. I'll send it to you as well. Feel free to ask any questions via email. All right.
Great job, Suko.
Appreciate you. All right, guys. So talk to you all soon. Take care.
Thank you, everyone, for joining us today. Have a great day.
Thank you. Have a great day.
Thank you.
All right.